I'm Ivan Fairhall, CEO of Mawson Gold. Mawson's listed on the TSX, and we're developing the Rajapalot gold-cobalt project in Finland. We've just released a PEA out. Mawson also owns 60% of the Southern Cross gold, which is an ASX listed spin-out. And we're moving the project forward.
Brilliant. Ivan, good to see you. Appreciate you coming on. I guess let's start with the numbers on the PEA, and then get into the so what. What does this mean? What do you do next? So let's hit me with some of those top line numbers if you don't mind.
Sure. Yeah, we've released the results of the PEA last week, and it's got a 211 million US market cap. We've been able to peg a value on the asset for the first time ever. This is the first time economics have ever been run over the project, and that's a 5% discount rate, US dollar 211 million after tax, 27% IRR on $191 million initial capex. Importantly, it's got quite a low cost base. We've got all-in sustaining costs of $824 an ounce, and that's been driven by quite a high resource efficiency. We're extracting a lot of the resource, and we've got very high recoveries, and we have we're in a jurisdiction and a location and have an ore body geometry that helps drive low costs, and the high gold recoveries drive low all-in sustaining costs on a unit of gold production basis. And when you put all those things together, you've got quite an attractive set of project economics as a starter project for us at Rajapalot.
Okay, well, explain this to me, because and I want to kind of pick you up on it, because lots of companies are doing it, and I've seen people come in at higher. But you've done the NPV5 based on 1,700 gold. I appreciate it's a moving target at the moment, but that says you've got a sense of how you'd like to portray and project the company's value today and into the future. So why 1,700?
Oh, so I did the analysis. I looked at every gold project that's been all the studies that have been done recently, and I wanted to be at the right part of the peer group. At the end of the day, these things are important for investors to understand things in an absolute sense, but it's also their relative. You're able to compare projects on a relative basis, and we're not using the highest gold price. We're not using the lowest. And I think we're sitting at the right point in the peer group. And we let the numbers do the talking, really.
Okay, so like for like, it was a conscious decision, not trying to kid anyone. It's just that if everyone else is doing it, why shouldn't we? Yeah?
That's right. Yep.
Okay, fine. No problemo. It's just that sometimes in retail looking in, they kind of forget to look at those numbers, and sometimes companies are using 2,000. Believe me, we've had a company come in recently and do that, and others are sort of doing a discount to the day price. So PEA is a good start, but as I indicated at the beginning, it's now a kind of so what. So what does that mean for you? What does it mean for your shareholders? And how should people looking at you view this company in relation to, let's say, some of the other early stage exploration companies?
Yeah, look, I think it's a really important point, and probably the thing that really we want people to understand the most. Like, in my experience, and I think is often true, companies go to this PEA stage when they've run out of options, and that they've sort of, because they're often run by geologists, that's what they like to do. And it's sort of like, well, we've got what we've got, and now, well, what does it look like economically? And that's just not how I view the world. It's not how we like to view the world. We've got a project that, we've got some mass around. It's like, well, wait, what do the economics look like? How does this thing work? What's important? We also needed to move the permitting process forward, like permitting, de-risking project permitting everywhere in the world, and ourselves included, move those things forward. And we've started our EIA process in Finland, and they're actually on us saying, come on, guys, like, tell us more. And it's pretty, I think I might have mentioned on a previous call, like, it's pretty hard to permit a project you can't describe or you can't write down. And so it unlocks a path of permitting. And what it does is now we've got some economics, and we know the value of finding more. So, if I'd gone to an investor and said, look, we've got this 1 million ounces equivalent, it's great, and we're going to go and find another, or here, we just found another 300,000 ounces. We've just moved it up to 1.3. If you didn't like one, you're probably not going to like 1.3. But now I can go to investors and say, look, we've just extended the mine life, or here's a drill plan to add ounces. This is what it's going to cost, and this is what it's going to do to the NPV. How's that look like for a return on capital? You've got a very compelling opportunity to talk to. So it's really about it's a sensible de-risking approach, and you're not spending capital on things that don't work. And it's also telling you what's important, what moves the needle, and how to add value in a quantifiable way. And it's really allowing us to valorize the upside that we truly believe exists on the property.
Right. Okay. But you've also got to be, good custodians of the cash that you've got and spend money efficiently too. And I appreciate the kind of picture that you're trying to build for the purposes of going out to market and raising capital when you need to. So where are you today? And, what's the timing on any kind of future capital raises to kind of advance this through? Because you're right, 1 million ounces is like, okay, you're saying, well, okay, it is okay, but we've given you a sense of what the economics could be at 1 million. Now it gives the money to go and find another million. That's a good conversation, but what's the sort of time frame there? What's the way that you will choose to spend your current money and raise money going into the future, given the economic climate?
Yeah, sure. So look, we've got about $3 million cash today. So, we have cash and we've reduced the burn because we've kind of come to the end of the PEA, and absolutely, like, exercising discipline in this market is an important thing. But at the same time, continuing to build on the story and keep your capital markets opportunity alive, they are all important things as well. And so, what we're trying to develop here is a strategy that is bang for buck in terms of exploration and the ability to, what really moves the needle for the project. And certainly we're not turning around saying we're going to go and do, like, one thing I haven't said, and if you actually read the things that we've said and listen to what I say, is we haven't announced we're doing a PFS. Now, this is not the market to be going out and drilling out this project. It's not the right allocation of capital in our view. And so, we think there's an opportunity exploration rise to add to it, and to do that meaningfully, they probably need to raise capital, but we're in no rush at the same time. So it's really about focusing on where we can, the biggest bang for buck, where we can add value for the least amount of capital is really the sensible approach, I think, in this market.
Okay, well let's dip into that. Okay, so no PF announced. I think that makes sense because, I think companies are coming out to market with these economic studies, and the market's going, I kind of don't care. It's risk off. But bang for buck for you is exploration. So if we drill down into that, pardon the pun, do you know where you're going to spend your money? And what sort of drilling, and, how many meters? I mean, because when you're sort of down this end of the kind of where the cash is at the moment, you've got to be, like I say, we keep saying it, you've got to be cautious, you've got to be efficient, but you also got to say, I want to advance this company, while others are kind of, fearful to tread or fearful to actually do anything or hunkering down. I want to advance this thing because I think that's the right thing to do. I mean, what's the kind of thought process, and more specifically, what are you going to be aiming at?
Yeah, so we've got exploration ongoing at the moment. We've done we announced that we were doing a big geochemical soil sampling, a till sampling program. We've got this area in the middle of the property that's never seen a drill hole. There's 8 kilometres between where we found the Rajapalot deposits, which go into the PEA. The original discovery on the property over at Rompus, for people who've got long memories, 6 metres at 617 grams a tonne. That's still the best hole that's ever been drilled in Finland. It's the same gold event that's flowed through there, and there's still a lot of the property, well, most of the property, 90% probably, has never seen a drill hole, and so we're working up targets in new areas that we haven't been to generate new opportunities, and that's low-cost exploration work. Starting with the geochemical sampling, we can move to base of till drilling to develop targets without blowing your brains out doing drilling. So we know, so that's one part of the exploration. It's where's the potential for a big bang moment to double, triple, find a Rupert. That kind of optionality, given the size of our property and the lack of exploration, and this is in the Nordics. It's the people that follow it really understand this, but it's good to remind, like, it's all covered by a thin layer of glacial till. You don't have outcrops, but so that makes life a bit hard sometimes. And the longer you explore there and you develop your techniques, and so the incumbents have an advantage, I suppose. People that have been exploring there, they understand the ground and can open it up a little bit easier. But the scale of the opportunity that lies beneath the till is what really can get investors excited. And Rupert is a good example of that. They came out of the blocks with, within 18 months with 4 million ounces. And that opportunity is there in Finland. It just doesn't stick out of the ground. The opportunity is huge. So that's on the bigger picture. How do you multiples of Rajapalot? How do you find those? We've got the other part of what I call the meat and potatoes exploration upside, which is we've got these deposits that go into the Rajapalot project. They're all open down dip. The deepest hole that is in South Palokas, which is the biggest body in the project. 31 meters at 5 grams a ton gold equivalent, and that's completely that's the deepest hole that's in the resource, and it's unfollowed up, so it's wide open. So being able to demonstrate the system extends at depth, that's deeper drilling, and so like that hole's 550 meters down hole, so it's 45 meters deep. So it's not 450 meters deep. So it's not deep in terms of depth, but they're longer holes, and that's a higher cost exploration program, and it's really about getting the timing right for something like that. And like you said, it's just exercising discipline and moving the project forward at the right point with the right capital.
Okay, so there's a lot of companies at your kind of stage, your sort of evolution, even with your sort of resource there, you got to try and stand out, and we as investors need to kind of decipher what is being said on a like-for-like basis. So apart from timing and apart from luck, what are the things which are going to help your company kind of stand out from that big crowd and actually come through this cycle, come out the other side? Because people are fearful of small projects because they could be marginal in some way, shape or form. They may be cash constrained in some way, shape or form, and there may be massive dilution ahead. So what are the things that you are in control of that can, I guess, make investors feel a little bit more comfortable that you'll be coming out the other side and perhaps are worthy of investment now?
Well, look, I think we've focused on the things that we can control, and that's what everyone will tell you they'll do in a market like this. And how do we demonstrate the value of our assets? We started by spinning out Southern Cross. We had great projects that were being ignored, not valued, not fully appreciated. So we spun those out, raised new capital into a market that will reward us for the exploration that's being done down there. And Mawson retains 60% of that. It's a company that's fully funded. It's shooting the lights out. They've got amazing results. And our share of that, we put $6 million into that company, groomed up that projects, listed them, and now our share, our 60% is worth $30 million. And you can look at the price on the screen, and that's the value of our stake. So, we've shone a light on the value in Southern Cross, which was being lost in Mawson before. So that's one thing that we've done, and is a good example of, how do you just rearrange the deck chairs a little bit and make more of what you've got? And then the PEA was the other big thing that we did. Rajapalot is a great project, and we believed that. And when you looked at the valuation, on any metric that you could pick, the value wasn't, we were not seeing value for that, but we were lost in a sea of resource valuation multiples. And the problem with dollars per ounce or valuations like that is that there's no filter on quality. And so it's just ounces, big low grade, big ugly low grade things, super high grade things, and you're all in the same group. Whereas moving to a PEA type stage, MPV, you're forced to take into account quality, cost, and consider those things, and you're able to actually demonstrate what the asset is really potentially worth, and all of a sudden we've ended up with Rajapalot, and it's like, hey guys, $211 million NPV, Canadian, that's $300, that's $1 a share. Now you can't measure it as directly as that, but if you want to then talk about what is the discount, we're trading at a deep discount. Even if Mawson was the only thing that Rajapalot, even if Rajapalot was the only thing that Mawson owned, Mawson would be cheap. We'd be trading at 0.15 times PNAV, which is cheap. If you like averages, you'd make money playing that average, and if you believe in mean reversion. Now, you strip out Southern Cross, our share in Southern Cross and our cash. We are trading at basically free, 0.02x PNAV. So this is a theoretical, but sort of it's actually also a practical argument. If you like averages and you like reversion to mean, these companies PEA stage probably should be trading around 0.3x PNAV if you look over a long period of time. we're trading at 0.03x PNAV. So technically, we don't even need to find anything more. And when this market sorts itself out, that deep discount that we're seeing at the moment, you just get natural re-rate for quality projects. And I think that being able to actually put economics around the project demonstrates a level of quality that a lot of companies are either unwilling or unable to go to. So we've done that. And the higher quality stories will survive. And we're really just working hard on articulating the value of the assets that we've got.